Hello everyone, my name is Renee and I'm the financial journalist from FSM1.com. There's been a lot of talk about an inverting yield curve being able to predict a recession. Let's find out what that all really means from Kean Chan, our macro research manager from FSM Singapore.
These days, investors can't avoid the seemingly dreaded inverted yield curve that peppers headlines the world over. First, I'll explain what the yield curve is. It's basically a chart that shows what the yields of various maturities of a certain bond are. The difference between the short end and the long end is a spread, and is positive in upward sloping yield curves. When yields on shorter term bonds are higher than the yields of their longer term counterparts, we get an inverted yield curve. Yields on the short end is anchored to a central bank's monetary policy, while yields on the long end are influenced by what investors expect of economic growth and inflation. Typically, investors buy long-term bonds even though yields are lower than the shorter-term counterparts because they expect yields to continue trending downwards if economic conditions worsen. Recently, the yield of the 3-month Treasury bill was higher than the yield on the 10-year Treasury note, resulting in an inverted yield curve. Investors panicked because historically, yield curve inversions tended to occur before an economic recession. My colleagues and I looked back across financial market history, and we found that if we use a 2-10 spread, the US Treasury yield curve tends to invert, on average about 19 months before a recession, going back to 1968. We also found that it is not exactly foolproof. Now, an inverted yield curve tends to constrain lending in the broader economy, which results in less credit growth, less capital spending and hiring, which ultimately affects overall economic growth. Financiers like banks earn the difference between what they pay out in deposits and what they earn from lending out to corporations and individuals. An inverted yield curve discourages them to lend, as interest margins are not as favourable. Although we wouldn't know with full certainty if it's really a precursor of things to come, we think that it's too early to panic. In this current cycle, the post-GFC world has seen a rise in regulations, and financial institutions must maintain high-quality assets as mandated by regulators. Sovereign bonds fulfill this requirement, and many institutions have to keep on buying them. This means that there are many price-insensitive buyers out there, depressing yields on the long end of the yield curve. This is one reason why an inverted yield curve may not be as valuable an indicator as it has in the past. Investors shouldn't focus too much on this variable. What matters most in investing is earnings growth prospects and the value you can get in various market segments. When equity markets trade at higher valuations, we should look to reduce exposure, and vice versa. When they are cheaper, we should look for buying opportunities. Even if you are just trying to predict a recession, relying on just one variable may not be a very good approach.
If you want to know more about the inverting yield curve, you can click on the article listed below. If you like this video, give this video a thumbs up and don't forget to like our Facebook page too. If you have any further questions for our research team, leave them in the comments section down below and we'll answer a few of them in the next Q&A session with Kean. In the meantime, stay tuned next week as our research analyst will share more about this quarter's top performing funds.